Curry, I received your even problems from this past chapter 13, and we have the rest of the day. I'll take those email up to 12 o'clock midnight, folks. So whether those are bonuses or part of your test, you do need to get them in. Today we want to look at I want to look at 1120 with you, which is a corporate form. So we're on chapter 2. You need to read that well, start to even problems, and we're going to look at a corporate return real quick. Got the 1120 form. Okay, I believe that's showing up pretty good. I would like to maximize it a little bit, but I can't. But if you look at this corporate form, and we'll be practicing one later, gross receipts, and we've got returns and allowances on 1B, we've got balance. It's just like doing an income statement in ordinary accounting. Subtract cost of goods sold, we'll look at that in a minute. You've got gross profit. Now, number 4 is dividends and inclusions. We'll look at that later. That's dividend income, interest income, rental income, royalty income, capital gain income. Net gain or loss on that 4797. We just looked at in 13. Other income. We got total income. Line 11. Just like an income statement. Then we go down to expenses. All right, now line 12, you've got to be careful with. You've got to attach 1125E, which I'll show you. Now, if somebody gave you line 13, said this is the salaries and wages for our whole company, maybe it's 200,000. Well, if the corporate officer's salary was 75 of that, you got to put 75 on line 12, and you put the 125,000 on line 13. You cannot double count, is what I'm saying. All right, 14, repairs and maintenance, bad debts. Bad debts, a corporation, IRS likes the direct write-off method. Then there's rents, taxes, and license. Now, taxes is real estate taxes. I probably would not put Social Security tax and Medicare tax in there. All right, interest and charitable donations. Now, charitable contributions, you may only get a certain part of those. We'll see. Then there's depreciation, 4562. We've had a chapter on that. There's depletion, there's advertising, pensions, profit sharing. Then there's employee benefit programs. I might would put Social Security and Medicare right here. And then there's other deductions, line 26, and total deduction and taxable income before a loss. If you had an NOL, then you've got line 29C, which is your taxable income. All right? Line 30 is your taxable income. Okay. Sarah has some information here for me. Sarah, stay here a minute. Now, we're talking to you just for a minute. Sarah gave me a note that you processed a senior's tax credit return but forgot to fill out form. You know who that was on? Was that one of his rejects?
One from last night.
Last night?
Mm-hmm.
All right.
It's considered a failed return right now. So
All
I have to
right,
go find
but
it.
now, I wonder if they deserve the senior citizen tax credit.
He put a notation that said something along the lines of no federal AGI because their Social Security only filed this for the senior tax credit. But the senior tax credit form was not filled out.
Now that senior tax credit, well, it's normally how much?
It's half of their property tax.
And they usually get a form on that. All right, and so go straighten that one out. But
You'll have to call the client and get the information from them.
well, right, the property tax.
On the form, it has the map parcel, the location, all that stuff. You'll have to get call the client. He has to call the client. That's a non-issue now. He has to call them. He has to get all that information, or have them come back on a day and time that they agree to bring the paperwork, so that they can work on it.
Okay, Cole, I hope you heard that. You got a couple more, Sarah. Tell him about the couple other, what he needs to do.
The other two one, it has no income, no refund, and no amount due for both state and federal. I don't understand that one. That's a prior return. And
Wait
then
a minute,
another
there was no income, no refund, no payment.
Yeah, I'm thinking maybe it was another senior tax, and he didn't put the senior tax information in, so he's gonna have to go back in and check that one. And then he has one that is a send state only, but did not check that box. He has to remember to, when he's sending just the state for the senior tax credits, he has to check senior or send state only.
Yeah. Okay, Cole, hopefully you heard all that. But had you been here today, we'd have let you got those straightened out. So the next time you're in class, if you can't get them straightened out, Sarah B1 will help you there. All right. But does Johnson have any rejects?
I've talked to Jonathan. I told him I fixed that reject. I fixed the one for Clayton that happened yesterday from last week's return. And then I'm submitting all of last night's right now. So.
All right. Hillary and Terry didn't have any rejects. Okay. Now, who's low on the list now as far as returns filed? Hillary?
I will check that as soon as I'm done processing all of these, and I'll send them each individual emails to tell them where they're at.
All right, Sarah will send you an individual email, but you cannot stop. We've got 2 more nights. We need preparers. All right? You cannot stop. If you do over the 50, each one you do over 50 adds a point onto your final grade. So after you have these next couple tests, you would like to have those points. So I suggest you get them. If you get 10 returns over, that is a letter grade. That raises your grade up from an 80 average to a 90 average. So keep that in mind. You don't want to blow an extra grade just because you feel like you're finished.
Yep.
Okay? All right.
I'll let you know if I come across anything else.
All right. Thanks, Sarah. And we made it last night, even though Savannah was sick. Nicole showed up, but we didn't have to use her. Sarah didn't have to do any last night. So between Cole and Jonathan, Terry and Hillary, they did about 36 returns. That was an average of about 8 apiece in a 3-hour period. That's pretty good. So guys, if H&R Block charges a minimum of $300, how much would you have made in an hour? And that's not just guys, that's Terry and Hillary. And Hillary got there probably an hour, hour and a half late, but she still prepared a lot of returns. So doing taxes is easy money. When you do a corporation return, you should get minimum of $500 per return, but a minimum now of $200 for a personal return, no matter how little. Okay, now looking at these, expenses, then we go down to taxable income. Now, corporations can file estimated taxes, and they should. So here's your total tax. We'll look at that in a minute. Here's your total payment. That's what you would have done estimated taxes and the amount owed or overpayment. So that's an income statement, folks. Page 1 of a corporate return. Page 2. Now, page 2 is nothing much. If we have investment in other companies, if we own less than 20%, I'm trying to find the rates. This is dividends from less than 20% owned. Dividends from 20% or more owned. All right. Dividends on certain debt financial stock. Basically, what I'm trying to tell you, and I'll have to show you those rates later, you get to exclude a lot of dividends a corporation does, and they don't pay taxes on them because they'd be paying twice. They should have some rates here, but if not, they'll show us later. Now, the rest of this form is just dividend exclusions, I think. Dividends, dividends, dividends. And usually that's pretty straightforward. All right, now page 3 is your important page also. Here is your tax computation. You bring over your taxable income. It says income tax instructions, which now should be somewhere around 21%, or we'll look at the brackets. All right. And you look at any kind of general business taxes or other taxes or credits, and every business gets some kind of credit for that U.S. production. But anyway, you get down to total tax, and usually that's a one-liner for us. We'll calculate it from the tables given. And then we get down to part B, payments, refundable credits. If we'd overpaid, we'd get a credit. And what else do we have down there? Refundable credits. We'll look at some of those credits. So we'll look at the credits, but that's the tax calculation page, calculation and credit. Page 4. Usually just short answers. This is other information. In other words, are you going to use the cash or the accrual method? My pen won't mark it all. And then you got to look up a business activity code. You can look those up. Business activity may be truck hauling. Product or service might be coal. And you answer the rest of these down through here. Most of that time probably is no. All right, we'll look at that. We'll print out a form, print out a 1120S form for your next class meeting. Page 5. Probably if you read all these, the answer would be no. Page 6 is your most important page. Balance sheet. A balance sheet from last year should be given. Now you've got to do a K1 reconcile on income for books with income on return. Okay. Now if you look at line 1, net income per books. Now your income per books and taxable income are two different things. Federal income tax per books, if you had federal income tax. All right, excessive capital losses over gains. All right, expenses recorded on books this year and deducted on. All right, they're recorded on the books this year, not deducted on this return. All right, you may have had a different kind of depreciation on the books. Charitable contributions, you can only take 10% of your net income. If you're deducting 20%, you can't take it all. Travel and entertainment, you deduct on the books, but you only take a part on taxes. Then you go over to the right, income recorded on books this year, but not included for the tax return. Certain deductions, such as depreciation, charitable donations. We'll look at those later. All right, now here's your retained earnings. Balance at the beginning of the year plus net income per books. There's other increases. We'll look at some of those. Deductions may be cash, stock, property, which are dividends, distribution. All right, other decreases. So if you've got beginning retained earnings plus income minus dividend, that's like a retained earnings statement in any accounting class. So an M2 is like a retained earnings statement. Now that has to go up here on line 24. That has to match. Now a corporate return, you got your assets. All right, down to, I guess, down to line 6, loans to shareholders. If you loan money to shareholders, you got to put that down as an asset. And this is loans, which is the liability. Investments are not. Here's your fixed asset, building, minus depreciation, depletion, and so on. There's no tricks on there. Intangible assets such as patents and goodwill. When you get down to liabilities, accounts payable, mortgage, other current liabilities. Now here on line 19 is loans from shareholders. If I loan my corporation $100,000, then they've got a liability. They owe it back to me. All right. Capital stock, you got preferred stock. You've got common stock. Here you got bonds. How you finance a corporation. Then you get down to retained earnings. All right, and you make that balance sheet balance. You may have to make it balance. Now that's the 5 pages of a corporate return. Now 1120A, I believe it was. Look at it real quick. Used to be part of the return. Effective for tax years beginning after December 06, Form 1128, a short form income tax return can no longer be filed. For the 2007 tax year, all domestic corporations, unless required to file a fresh return, must file the long form 1120 U.S. corporate return. Okay? Okay, but I guess I was trying to find cost of goods sold. And what they say about cost of goods sold on 2, they said look at 1125A. That's what I was trying to find. Sorry about that. Okay, that's it. Cost of goods sold. Now this is like doing an income statement. You've got beginning inventory plus purchases. Basically, you got minus ending inventory gives you cost of goods sold. Now, however, if we add labor, beginning inventory plus purchase minus ending inventory gives you cost of goods sold. But if we add labor, like when I was in the used car business, I might, if I had to repair cars, I'd add that onto the cost of goods sold. That was cost of labor. Now, other costs, I may have put new tires on it. I'll add that to the cost of the car. That would be materials cost. So down the line, 8 is nothing new. Now you got to value your inventory, cost, lower cost to market, or other. If you do FIFO or LIFO, it would be other. So pretty much, cost of goods sold, like an income statement. So folks, just looking at that form introduces you to chapter 2. Trying to get some lights to turn on in here. Chapter 2, corporation. Homework, do the even problems. I'm going to have to start counting these problems, maybe as part of your test, because you're not in class for us to go over them and me to ask you questions or anything. So please do these problems. Now, I will take up the even problems on this chapter, probably on the corporation chapter. We'll try to have them by Tuesday. I may give you a state of Thursday if you don't have them by Tuesday. Even problems on corporation, chapter 2. All right. Now, one of the big things we did at the beginning of this chapter, they will be on test, of course. Organizational forms available. Then we're going to look at advantage and disadvantage of a sole proprietorship, a partnership, and a corporation. Now, that's the tax advantages. That doesn't throw in the unlimited liability as a disadvantage for proprietorship. It doesn't throw in unlimited capital raising money for a corporation. All right, so those big three, proprietorship, partnership, and corporation. I want you to look over the tax advantages, disadvantages that will be on a test. All right. Legal requirements and tax consideration related to forming a corporation. All right. You definitely want to look at the tax considerations. Some of these new residential potentials, they're recommending a 90% tax on corporation. It was up to 39. Trump got it down to 21. And if a corporation pays more taxes, they just raise the price of their goods. So if we put a 90% tax on corporation, something that cost us $5 may cost us 10. Because the corporation would want to clear up more income. So I don't know what will become of that. If you want to become a corporation in West Virginia, just write the State Corporation Commission and tell them your interest, okay? Now I want you to look at page 211. If you transfer property to a corporation, the best way to do is start a corporation and all stockholders invest cash. You have no problem. When you start investing in your pickup truck and your computers, you got page 11 to deal with. Fair market value of the stock received, money received, fair market value, what have you. We'll have to look at those. Look at some problems with them. Somewhere down the road, if the corporation sells it, who pays on the gain, the corporation or the partner? That is section 351 on page 12, deferring gain or loss upon incorporating and transferring assets. There's a lot to do with control, who controls the corporation and who don't. So read page 13, 14, well, if you need something explained, I'll look at it and do it. At the bottom of page 16, it still mentions, of course, section 351. Know what section 351 is? That's simply if you donate property, land, building, machinery, trucks to a corporation. What's the corporation base? Who's taxed on the gain? And is it deferred? And the major requirements on page 17 in the blue, the recognition of gain or loss applies only to transfers of property in exchange for a corporation stock. It does not apply in exchange for services for stock. All right? Property, not services. So you can circle those two items on page 17. It applies to property, not to service. Now, the property transferor must be in control of the transferee corporation immediately after the exchange. Control means ownership of at least, 80% of the voting power and at least 80% of the total number of shares of all classes. Now, this is to get this section 351 benefit. You own 80%, it's different. You don't get none of this. None of this works if you don't own 80%. The non-recognition rule applies only to the gain realized in exchange of property for stock. If the transferor receives property other than stock, such as property in consideration of boot, the transferor recognizes gain to the extent of the lesser of the fair market value of the boot received. Okay. If I transfer a truck, let me tell you what this is trying to tell you, show you. I have a pickup truck worth $20,000, and I transfer it to the corporation. I own 80% of that corporation. All right. Now let's say my basis. Well, let's say the corporation received the fair market value is $23,000. All right. Now, if I sold that, I'd pay taxes on $3,000 gain, realized, recognized. Here I've got a $3,000 realized, but I don't have to recognize it till the corporation sells it. Now, if the corporation gave me $20,000 or $22,000 worth of stock, but they give me $1,000 cash, this cash will be taxed. That's what that line is telling you. So we really need to work on 351. You need to read all about 351. All right, look at your examples always. Look at example 25. John transferred two assets to a newly formed North American in transaction qualifying in part for the tax-free treatment under section 351. The total fair market value of the assets is $100,000. Okay. So let's go over to the next page, 18. And you see the total is $100,000. And you see Asset 1 is 40% of that, and asset 2 is 60. Now, received by John consists of 90,000 of North stock and 10,000 of notes. 90,000 stock, 10,000 notes. Now, the following data illustrates how Joan determines her realized and recognized gain. Okay, the fair market value of that 100,000 is 40. Okay, consideration received in exchange for assets, stock times percent of total, notes times percent of total. All right, you receive 90,000 stock. So actually you're receiving 36 for asset 1, 54 for asset 2. The total proceeds are 40 plus 60. And adjusted based on that first asset, you got a loss of 25. That second asset, you got a gain of 35, which is a total gain of 10. So boot received, just go back to 40%, 60%, is 4,000 and 6,000. And that's what's recognized. You could have got that without going down that whole page. Okay? Boot received, recognized, and realized. So please look at your examples. Now look at page 18 and you'll find out the holding period. All right? The transferor's holding period for any stock received in exchange for a capital asset includes the holding period of the property transferred. So if you bought equipment 3 years ago and you get stock for it today, your holding period of that stock goes back 3 years. It's already long term. So keep that in mind. All right, please read page 20 real well. Tax considerations to the corporation that receives the items, transferee. Now look at what it says about gain or loss recognized by the corporation. Corporations recognize no gain or loss when they issue their own stock in exchange for property. Now look down at example 29. West Corporation pays $10,000 to acquire 100 shares of its own stock. Now we know that's treasury stock. The next year, West reissues these 100 shares in exchange for land and having a $15,000 fair market value. They realize a $5,000 gain on the exchange, but recognize there's none of the gain. You just take the old basis. That's the corporation. We were talking about individuals a minute ago. So read about whose basis and who transferred and who didn't. That's what this chapter is about. And liabilities of a corporation assumes them from the transferor, then the transferor, that's the same as receiving cash. All right, we're going to try to look at a couple of problems, a few today, but please read that chapter and I'll point out a few things later. But to look at information, we really need to look at some problems. All right, we're going to look at the odd problems. Now, if you're at home and you're watching today, take a minute while I bring up solutions and read C2-29 on page 2-38. This looks like, I don't know, chapter. I don't know what I've got up here. That's chapter 11. I got to go to chapter 2, corporations. That might make sense. All right, if you've read that problem, 29, what is the amount of Dick's recognized gain or loss? And you can see none here. And Dick does not recognize his $10,000 recognized loss, realized loss, not until he has a real transaction. Now, B part, what is Dick's basis in his Trenton shares and when does the holding period begin? He has a $60,000 basis, and the holding period is deemed to begin 3 years ago when Dick bought whatever it was he traded. So if we go up there and read now, the current year, Dick, Evan, and Fran formed Trenton Corporation. Dick contributed land, a capital asset having a $50,000 fair market value in exchange for 50 shares of stock. Now, $50,000 fair market value. All right. Now, the stock, 50 shares of stock. He purchased the land 3 years ago for 60. Now, that's why they say he was trying to have a loss, which he don't. He contributed machinery, somebody else, Evan, and so on, going on down. So anyway, we're taking care of one taxpayer at a time. Now we're going down to Evan. He does not recognize the $15,000 realized loss. All right? Neither one of them recognize these realized losses. Now, D, 45,000 base in Trenton shares received. Evans' holding period is deemed to begin 4 years ago. Now, I would divide my number of shares into my basis of 60 and know how much I had per share. Fran recognizes 20,000 of ordinary income. Why? What did Fran do? Services for the corporation? So let's see what Fran did back in the problem. Fran contributed services worth quitting. Well, she's just going to pay taxes on $20,000 and hopefully W-2 wages. Trenton takes a $50,000 basis in the land, that's what stock they gave up, and $30,000 basis in the machinery. Because of the lost property limitation rule, the basis of these assets are reduced and their respective fair market value, assume the parties do not elect to reduce stock basis. So it depends on what the parties decide to do. All right, now I want you to do the even problem. So 30 is about the same question. We're going to look at 33. In which of the following independent situation is the Section 351 control requirements met? Well, we saw the 80% rule, and we're going to see what else might come up. All right, number one, A, the control requirements are not met. Transfers will probably receive only 75%. Well, that's less than 80, folks. Now, B, the control requirement is met. Robert transferred more than enough property. The 80% control requirement is met. C, the control requirement is not met. Sam owns only 33 1/3%. D, the control is not met. Is met. Charles and Ruth together own 100% of Tiny stock. The transfers do not have to be simulated. Now look at D part. Who is Charles and Ruth? Are they husband and wife? Are they considered one? Wait a minute, am I on 31? Yes. For D part, Charles and Ruth developed a plan to form on June the 3rd of this year. Charles transfers property worth 50 for 50 shares. And on August the 1st, Ruth transfers cash for 50 shares of Tiny stock. I don't know who Charles and Ruth are, but both of them together own 100%, and the control requirements are met. Okay, E, the control requirement is not met. Charles had a prearranged plan to sell a significant amount of shares. All right, failed to meet the control test. It was not 80%. So anyway, that's just going over the 80% rule. That's not too hard to comprehend. Okay, let's look at number 31. No, that's another control requirement. You're to do number 34, and we'll look at number 35. Incorporating a sole proprietorship. All right. That should be easy to do. We need to break it down. Cash, equipment, building, land, and total. Cash is cash. That's no problem. All right, fraction of total value would be 5,000 divided by 165, wouldn't it? Almost 3%. Fair market value of stock received. Okay, we'd have to multiply it by the fractions. Total proceeds. That's book property. Proceeds that each person received. Not person, but each asset allocated. Okay, adjusted base of an asset. Cash is adjusted basis is the same. The equipment, you would have a gain realized of 30,000. The building, a gain, a loss. The land, a gain, and a total gain, I guess, no total. Allocation of boot. All right. A gain recognized. Cash, nothing. The allocation of the boot is what you pay taxes on. That's recognized. The boot was 40,000. You should be able to get these amounts by the percent. Okay. All right. Now that was 30, 35, I guess. Let's look at number 39 real quick. Just a moment. Well, I was getting a text from one of you. Uh, okay, just had to look at the message, see if you all are asking a question. Okay, let's look at this one. The amount we got out of this property was 170,000. Basis in the land was 30, so we got a realized gain of 140. The amount realized would be cash plus assuming mortgage or whatever. All right, boot received is 20, and gain recognized is 20, just a boot received. So that is an easy little problem, like something that you have to do on the even sections or easy problem. B part, 30,000, basis of common stock and preferred stock, 30 plus 20 minus 20 is equal to 30. This basis must be allocated to common and preferred based on the market value. If you got a total market value of 100 and 150, that's probably 20%. Let's see, no, 100 over 150 would be 2/3. I guess 2/3 of 30 is 20. That's what it is. That's 100 over 150 is 2/3. The base of preferred stock is 50 over 150, which is the other 1/3. 1/3 of 30 is 10. Base is a short-term note. The fair market value is 20,000. Base is a land to Temple Corporation. 50 divided by 30. Minus 30 plus 20. All right. Now that's all I'm going to do on corporations today. And I want you to be doing the even. That's all I'm doing on this chapter today. Now, the corporate income tax rate on page chapter 3. And we're going to try to go over this chapter on Tuesday, probably. And Mr. Ima wants me to help him somewhere out in town next Thursday. I'm probably going to give you a test on chapter 2 and 3 on corporation next Thursday. Of course, it'll be open book. Now, here in this corporation, on page 3-2, you got to choose a calendar year or a fiscal year. That's easy enough. All right, you got to choose an accounting method on page 4. Accrual versus cash versus hybrid. And look at the income test. And then corporate tax rates. I don't know if they've incorporated. It says prior to the enactment of the Tax Cuts and Job Acts of 17, corporations faced a gradual rate ranging from 15 to 35, with two bubble rates at 39 and 38. However, prior to 2018, a corporation having more than 335 taxable income would have had a 34% tax rate. All right, so read about the new law, which is a flat tax rate of 21. Capital gains and losses for corporation are different. They don't recognize them this year. So I want you to look at page 6. Please read some of these things, even about the charitable deduction, where you limit to 10%. What you do with gains and losses, do you carry them forward or back, or take them this period? All right, so these are some important things. So when you get time, read chapter 3, corporate taxes. Okay, I'm going to call it a day. It's harder when there's no one here, but we put in about 55 minutes, I suppose. And you've got a lot of work to do. I hope some of you get me those even problems on chapter 2 on corporations. Terry's already got them to me. So we're going to call it a day. So hopefully I'll see